Welcome. Introducing myself, Van Ritchie, sales consultant of Your Land Developments in partnership with Mortgage Domain. We have an amazing opportunity to present to you a couple of episodes on finance and around buying property. This is the final episode of our 3-part mini-series. If you haven't watched the other episodes, you're more than welcome to have a look at them and go through some of the topics around finance. Episode 3. This is the third and final session, as I mentioned. Our guest expert will tackle a few more complex subjects for our purchasers. And the special guest that we have today is Mark at Mortgage Domain. Mark, would you like to introduce yourself?
Yeah, absolutely. I am Mark from Mortgage Domain. Mortgage Domain are a construction-focused brokerage. We've been around for the last 6 years. I myself have been in finance for the last 18 years. So we specialise in construction or home and land finance. It's what we do day to day. And we service quite a lot of clients in this space. So they're to sort of guide our clients throughout the entire construction journey. So from, I suppose, signing a land contract all the way from them to, constructing their home and moving in. So we're basically holding our client's hand anywhere from 6 to maybe about 18 months throughout that journey.
Thank you, Mark. Thank you for joining us. Today's presentation, our main topics are valuations, stamp duty, and land tax. Let's get into it. So what is valuation? What can I do if my valuation is low?
Yep, great question. So every bank usually will employ an independent valuer or an independent valuation firm. So basically, a valuation is conducted by this independent firm on behalf of the bank. So they're an agent, I guess. The banks usually don't have any influence, or we assume they don't have any influence on the actual price of the land and the building when the valuer completes the report. Usually, for a valuation to be completed, there are a few different metrics that need to be considered when they do complete their report. So they need to look at 3 comparable sales over a 6-month period. So when we say comparable, they need to be comparable in land size, build size, and obviously resale market as well. The sales can't go back more than 6 months. In certain areas where there, I suppose, growth corridors where there are a lack of comparable sales, so let's say a certain price point, we can't find sales that match. They may be able to go outside of that 6-month period, but it needs to be actually approved by the bank and their credit team for this to go outside of their policy. Usually when we do get low valuations, we need to provide the bank and the valuation firm, 3 comparable sales outside of the sales that they've actually considered for them to reconsider that. We do see quite a lot of fluctuation in valuations as well. So usually one firm can be very different to the next firm. It's my opinion that the report or the valuation is a matter of the valuer's opinion and what they think it's worth as an individual. I've seen variances between similar properties within the same firm valued by different people within that firm. So just based on our experience, we have access to, I'd say, about 12 different institutions or 12 different lenders where we're actually able to order an upfront valuation and just make sure that it actually meets the requirements of what the client's purchasing. So if we do get low valuations, yes, we can contest them. But usually what I find is, obviously, if we order multiple valuations at different institutions, we can see if there's going to be a variance. And obviously we can then sort of present to the client or you as a customer what's going to be the best solution sort of moving forward. As I mentioned, we can order valuation without an application being submitted to the bank. So if we do have an issue with a low valuation and we've got an application submitted at that particular bank, we want to sort of avoid having multiple credit checks just to avoid any potential issue with getting another solution for your new loan. So we'll order an upfront valuation for you. when we're getting valuations completed, there are certain things that the valuer will look at. They'll look at the land price in isolation. They'll look at the bill price in isolation, and they'll look at the overall value of the contracts and see what's being resold in the open market. They do measure each of these metrics individually. So they'll look at obviously the price per square meter rate. So that is something that they do consider. They'll look at the actual build cost as well, and obviously look if it's relative to the size of the house that you're building. So it's important that obviously if you're building a certain size house, that you're not going too crazy when it comes to upgrades. You want to make sure that the upgrades do translate to value. So let's say if you're building a 20 square house and you've got $100,000 in upgrades in that property, you're probably not going to get a valuation that'll stack up, because obviously, it'll have to also match the resale market as well. So 20 square house in this particular area, what sales are actually being generated, and do they match the price that you're paying? So these are the things that the value will take into consideration. Usually we can see that, if the land contract has been sold quite some time ago and there's been an uplift in the valuation on the land, if that valuation or the contract's been sold more than 6 to 12 months ago, depending on which bank we go to, we can actually use that uplift in land when it comes to reducing your loan to value ratio. So the lower the loan to value ratio, the cheaper your mortgage insurance can be. So that's something to take into consideration. But yeah, that's basically how we sort of combat any low valuation. So we can order multiple valuations at different valuation firms, or we can provide the value with comparable sales.
I definitely feel that is an important point there that you've made, Mark, because it's also the value that's added to actually engaging a broker.
Yep.
The other thing that I'd like to add to that too is that you brought up that the value of your home as well. So it's definitely something to consider, that there is the value of the land and there's also the value of the build. So thank you so much.
Yeah, and I think like some people do. Sorry, just to go back to the last slide. Some people do get disheartened if they're going to a bank direct. Obviously, the bank will only have access to one particular valuer, so they don't really get a second opportunity to correct that valuation. Once again, dealing with a broker, you've got access to, let's say, 45 different lenders, and most of the lenders these days will allow us to order upfront valuation. So an upfront valuation is prior to the loan application. So we'll obviously exhaust those options before we say that we do have a low valuation, because I personally have seen variances between a property with one valuation firm and the next, anywhere from $50,000 to $100,000 in some cases. So definitely encourage that you order multiple valuations if you do get one that does come in below the contract price. Sorry.
So it's definitely an advantage that you can go through a broker and get multiple valuations, because if you do get one valuation from one bank, they may not necessarily allow you to challenge that valuation. So fantastic. All right. Can I move on, Mark?
Yeah, absolutely. Sorry.
Next topic, stamp duty. Stamp duty, can I avoid it, or can my broker help me manage it? You did touch on this in our previous episodes, and if our customers have missed that, please go back, because there are some points that Mark brought up in regards to stamp duty and whether it applies to you or not. But stamp duty, can I avoid it, Mark, or can you help me with that?
The answer is yes and no. So you can avoid the stamp duty if you are a first home buyer and you meet the requirements of the State Revenue Office to comply. So provided your land value, or the dutiable value, is what we call it, doesn't exceed $600,000. So usually when you're buying land and then building, the dutiable value is based on just the land value alone. And if that doesn't exceed $600,000, then there is no stamp duty that's applicable. You still have what we call transfer of land, and transfer of land is based on the value of the land contract. But that's a very small charge in comparison to what stamp duty is. Stamp duty, if you're not a first home buyer, that will apply, and there are different rates, right? So what I mean by that is, if you're buying for principal place of residence purposes, or what we call an owner occupier, so that means you're going to live in the property, stamp duty will be one rate, right? If you're purchasing as an investor, their rate is slightly more expensive than the principal pays the residence rate. Just be mindful as well when we started talking to investor clients. If they're buying something that's off the plan or what we call like a one-part contract, typically the stamp duty will be based on the full purchase price. So if you're buying an apartment, let's say for $700,000, it'll be based on that value. Whereas when you're buying home or land and you've got a land contract at $350,000 and a bill contract at $350,000, so the total amount still equates to $700,000. The stamp duty won't apply on $700,000. It'll be based purely on that land contract. So there's quite a bit of savings there if you are an investor to buy land and building when it comes to stamp duty.
Fantastic. So definitely customers who are looking at buying, there is an advantage around buying land and stamp duty. So thank you. Let's move on. Land tax, Mark. Is it applicable and how is it calculated?
It's something that we
get this question a lot.
I do. We do actually. So usually, whether or not land tax is going to apply, normally that information will be held within the actual land contract. As a broker, we don't really have any sort of impact, and it doesn't really sort of have anything to do with what we do day to day. In terms of how to calculate it and all that sort of thing, I don't really know the answer to that. We always talk to our customers and we point them in the direction of the State Revenue Office's website. And there's a link below as well. So if you wanted to sort of revert to that, you basically punch in your land information and it should give you an estimate as to what the land tax would be associated with the value of the purchase price for the land that you're looking to purchase. So the link is there again for anyone that wanted further information on that.
Yes. So when customers do ask us sales consultants, land sales consultants, about land tax, it does vary quite a lot. And therefore, we do, as part of a customer's due diligence, to actually go to the State Revenue Office site and do their homework, I guess, in regards to land tax, because you can't pinpoint an amount. And so this is a really good point where you can go to the link and have a look, and you can even call them up as well. I know lots of customers have called up the State Revenue Office and had a really good discussion, and they're a really good point of contact for land tax. Yeah. Thank you. Getting in touch. So this is our final session out of the 3 episodes. So if you did love this one and you want to look into our other topics, you can go back to the other episodes that we have created to help you look at finance and around buying. If you do want to get in touch with us, you can. Your Land Developments at melbourne@yourland.com. If you want to reach out to Mark and his wonderful team to get some support and some guidance, you're more than welcome to as well at hello@mortgagedomain.com.au. Thank you, Mark. Thank you so much for your time. I know you're incredibly busy and we loved having you. Thank you.
It's been my absolute pleasure.